Now, one of the questions that I'm always asked is, Scott, should I be buying a property in my personal name, or should I be setting up a trust and buying in a trust? I get asked this question all the time because there's a lot of misinformation out there on social media about trust, that somehow trusts have this magic ability to save you billions and billions of dollars in tax and wipe your tax debt down to zero. That is not the case. And I'm going to give you the truth now. Hang through this whole video because I will speak through to you. And by the end of this, you're going to have a bit of an idea of what you need to do in terms of buying an investment property in your own name or in a trust. Hey everyone, it's Scott here with another daily property update from Freedom HQ. And if you do get value from this video and you want more information like this, help me out, help the algorithm out, hit the like button, hit the subscribe button so we can get this video to as many people as possible. So after actually helping over 10,000 property investors, here is my take on trust versus buying in your personal name. And please guys, this is not advice to you. This is just for education purposes only. Make sure you get professional advice, certified advice before you make any decisions. Should I buy my first investment property in a trust? It sounds smart. It does sound advanced, but let me actually walk you through the numbers because the numbers don't lie. Now, step one, what you actually do is you may refinance your main home right now, get some equity as a deposit on an investment property. You then transfer that into the trust, right? Because the trust will be buying the property. Let's say you pull $100,000 of equity out of your home. That loan, that $100,000 is in your own name, but you put the money into a trust. Straight away, there's a problem right there. The debt is in your name, the property is in the trust. That breaks the tax link. So the interest on that $100,000 loan at say 5, 6, or 7%, that is $5,000 to $7,000 a year, which will now not be a tax deductible expense. So you will not get a tax break on that expense. That is tax inefficiency. Step two, the loan in the trust to buy the property. Now the trust goes and borrows say another $500,000 or $600,000 to buy the property. You've already got 100 grand there as a deposit that you got from refinancing your home, but you now need a loan in the trust to complete the purchase of the property. And to make it easy, let's just use 5% interest. That's another $25,000 of interest a year in repayments. Then add another $5,000 a year for council rates, insurance, maintenance, property management. So the trust now has total costs every single year of $30,000, just as an example. Step three, the rent. Now say the property earns $400 a week in rent. That's about $20,000 a year. So here's the equation inside the trust. You've got income, rental income of $20,000 minus your costs of $30,000. That is a $10,000 loss every single year inside the trust. Step four, the tax problem. Now here's the killer guys, that $10,000 loss is stuck inside the trust. You can't offset it against your salary. Normally, if you're buying the property in your personal name, that $10,000 loss would be offset against your income, reducing your taxable income and providing you with quite a sizable tax refund. Let's say, for example, you're in the 45% tax bracket and you've made a $10,000 loss on your investment property. You'd receive a $4,500 tax refund on that loss. So essentially the property is only going to cost you $5,500 a year to hold, and then you can enjoy the capital growth on that property. However, because you have purchased this property inside of a trust, that $10,000 loss stays within the trust and you cannot offset it against your personal income. Now, assuming that that trust has no other income, then that $10,000 loss can only be offset against the rental income, which is not very much and actually is within the tax-free threshold. So think about that. You've got your $100,000 that you refinance from your main home with interest repayments on that, which are not tax deductible. You've also got another $10,000 loss inside the trust, which is also not tax deductible. Therefore, this is going to put massive pressure on your cash flow because you do not have those tax deductions coming in to supplement the holding costs of holding that investment property over a 10 to 15 year investment window. Now, if you buy that property inside a trust, eventually in the future, you're going to sell that property and there will be capital gains tax profits which will come through from the property. The benefit with the trust is you can split those profits amongst different beneficiaries or different people from the trust. And if you've got multiple people there, you can split that gain amongst multiple people and possibly reduce the tax. But think about this. If you've bought a $500,000, $600,000, $700,000 property, you've held it for 10 to 15 years. When you sell it, you're going to be making $500,000, $600,000, $700,000 of profit, because the profit is quite a lot of money, and spreading that money across enough people who already have little income or zero income to be able to get any type of tax benefit when you sell is going to be quite difficult. Okay, Scott, so why do people even buy in a trust? Well, the main reason that people do buy in a trust is because they want asset protection. So if you're a business earner, or if you're known in the public, or if you're a high earner, many people may attempt to sue you and take your money. If you buy your assets in trust, it makes it very, very hard for people to sue you and take those assets and take that wealth from you. So this is actually the main reason. Now, many people that have really, really great cash flow that want the asset protection are not too worried about having those losses stuck in the trust because they have plenty of cash flow. However, for 99% of the members and clients that I have worked with over the past 16, 17 years, everyday mum and dad investors, that cash flow sacrifice is way too much. We in fact need the ability to offset those losses against our income to have that cash flow benefit and have that tax refund benefit. So for most people, it is actually going to be better to buy your first 1, 2, 3 properties in your personal name for cash flow reasons. Now, of course, if you want that asset protection, you can look at purchasing in a trust. Now, I've given an example where there's a $10,000 loss, a cash loss. But if you buy a brand new property, you're also going to have depreciation, which is a on paper loss, which could add another $10,000, $15,000, $20,000 a year to the expenses of the property. They're not real expenses, they're on paper expenses. It's called depreciation. It's only available on brand new property. So that could actually take the loss of the property from say $5,000 to $10,000 to something like $15,000 to $30,000, meaning you are giving up a lot of tax refunds when you buy a brand new property by buying in a trust. If you want more information around this, go and see your professionals, your advisors, or absolutely speak to someone from my team. Just hit one of the links in the description. Take care, guys.